Hello and welcome to the Essential Trustee Training 101. This session is sponsored by SIIA, the Self-Insurance Institute of America, the leading organization promoting the health and well-being of the self-insured community. Today we're going to discuss trustees' responsibilities. And first off, I have to say the trustees are really the representatives of the members elected to act in the best interest of all members of the group. They provide direction and support to the administrator on strategic and tactical matters that impact the entire group performance. Today, the learning objectives, we're going to talk about the overview of group self-insurance. We're going to talk about the causes of self-insured group failures, fiduciary responsibilities of all trustees, plan administrator and vendor management, financial statements. Trustees certainly need to understand how the performance of the fund is being reported to the regulators, and also fund management strategy. Self-insured groups have been an important cost-effective alternative for employers since the 1970s. In group self-insurance, organizations or businesses join together for the common purpose of providing cost-effective, stable workers' compensation coverage to its members. They do this rather than going to an insurance company. There are a couple of types of groups. The first is a homogeneous self-insured group. These are organizations of businesses of a single industry. They get together in an individual state and form a small insurance pool. The other are heterogeneous self-insurance groups. These are organizations and businesses of multiple industries. It could include manufacturers, retail, transportation, and all other types of programs, as long as it's okay by the trustees and the original governing documents. All of these programs are single state by design. They're governed by the state of domicile. The regulators responsible for governing these could either be the State Department of Insurance or the Department of Labor, depending on the jurisdiction. Self-insurance groups are essentially single state workers' compensation insurers. They must perform all of the typical functions of any insurance company. Self-insurance groups, they have to establish their own service contracts with third-party administrators, which are TPAs, financial auditors, investment advisors, and all the other vendors so that the services can be performed. Otherwise, they have to hire those people directly and incur the cost of fixed expense of hiring those folks. They perform basic functions for their members. They issue policies or certificates. They pay the losses. They collect premiums. They manage the funds and investments. Everything that an insurance company does, the self-insured group must do as well. They also purchase reinsurance or excess insurance to cover the group for the types of losses that are unimaginable, the brainstem, spinal cord, serious burn injuries. They need specific excess coverage for that. Other coverages involved might be aggregate coverage, and aggregate coverage protects the fund on a stop-loss basis for all losses in any one year. Members own the profits of the organization, so surplus can be returned to members based on the group's bylaws and the member documents in accordance with state regulations. The states will not allow you to return money too fast because then they would have to assess to get the money back again. So you have to issue dividends based on a policy that's approved by the state regulators. Why do employers choose group self-insurance? Typically, employers join groups because they have lower upfront costs. The premiums for a self-insured group are oftentimes less than that of the primary insurance companies. So lower upfront premiums is definitely a plus. The fact that members own any profits, there's the opportunity for surplus distributions back to the members. Typically a self-insured group, because they concentrate, at least the homogeneous ones, they concentrate on a specific industry. There are opportunities to develop very specific safety and loss control programs. Self-insured groups tend to invest more in safety and loss control specific to that industry, and as a result, the members benefit from having stronger risk management and loss control programs inside their own operations. Stability through market cycles. That's important because in the primary insurance world, the marketplace has gone through periods of extreme price competition when premiums become very low, and then there are periods of extreme retraction in the marketplace where insurers don't want to write workers' compensation and the prices skyrocket, causing hardship to the employers who have to pay those premiums. Because self-insured groups control their own destiny and can set their own rates, they have to be both prudent in a soft market and in a hard market for pricing, but stability through the cycles is possible. Self-insured groups also control the best practice claims management process. They get to decide how much effort, what services to provide, how aggressive claims administration should be, and because of that, again, frequency and severity can be impacted. Losses are lower as a result of best practice claims management programs. So basically for a self-insured group, employers get a better deal up front. They have an opportunity for a distribution, receive the profits back at the end of the day, and that would be both the underwriting profit and the investment income. And their employees are treated better in the claims process, and better claims practices are applied, and costs come down as well. It should be noted that poorly managed self-insured groups, like any business, can fail and have failed. So have insurance companies. Engaged trustees are critical to prevent SIG failures. There have been some significant recently published failures in the state of New York and also in California. The 8 trusts in New York were managed by the same administrator. They were closed down by the regulators in 2008, leaving a deficit behind of over $500 million. In addition, that administrator had also moved out to California and was permitted to continue to operate groups in California. Because this is a state-by-state regulated industry, that type of problem can occur. The group administrator was not focused on the best interest of the members. They were compensated based on volume. Their incentives were to grow the fund as fast as they could without regard to underwriting, without regard to claim administration. In addition, the TPA, there was a conflict of interest in that they were the same entity, and the TPA was incented to keep reserves low to show that the group was growing successfully. Consequently, it was false information being provided to the trustees of these particular programs. In the state of New York, the enabling legislation was passed. There was no increase in budget at the regulatory level. Overnight, multiple self-insured groups formed. The state of New York ultimately had around 80 of them. The state was simply unable to monitor and assess the true status of each operating trust as a result of that. The trustees were rubber stamping the work of the administrator. The only nourishment they got, the only information they were receiving was the information controlled by the administrator. And so they did not really understand what was going on with their program. In addition, these programs, when they were out soliciting business from agents and directly from customers, they did not explain joint and several liability correctly. or at least it's been alleged that. Consequently, it's been very difficult to collect on the assessments required to fund that $500 million deficit. Many of the members of those programs refused to pay because they contended that they were provided insurance. They didn't know they were joining a self-insured group. So there were several problems associated with these things. In hindsight, they should have been clear to everybody. And in hindsight, the trustees should have known. Failure of groups in New York and California occurred for a variety of reasons. Certainly the motivations of the administrator / TPA / loss control, they were all under the same house. Their incentives were to grow the program without regard to underwriting profit. It was up to the Board of Trustees to make sure that underwriting profit was also part of the game, and that didn't happen. Trustees relied on the financial statements and the presentations of management without really taking a look at an annual actuarial review or audited financial statements. Any one of those practices could have helped identify these problems. The trustees have to operate independent of the administrator. They must weigh in on decisions and help direct and control the administrator, and that didn't happen here. In addition, there was inadequate state oversight, and again, that was partly a funding problem. The enabling legislation went into place. No funding went into that department, and overnight there were another 70 or 80 of these programs to be watched and managed. They failed to see the problem until it was too late. Bottom line, the trustees of the program have a responsibility, a fiduciary responsibility, to understand and direct the management of these programs to a solution and to operational results that are in the best interest of all the members, not the best interest of the administrator, not the best interest of the TPA. It has to be in the best interest of the members. That's called fiduciary responsibility, folks. So what constitutes fiduciary responsibility? The reality is there's only one party you are responsible for when you're weighing in and making decisions for the group, and that is the group members. You make decisions that are in their best interest. The cap you wear as a trustee is the cap to represent all members. And you can't take in your own personal interest, your personal bias, your friendships. None of that can be brought to bear when you're making a decision. It has to be in the best interest of the members. Every decision you make has to be made in the best interest of the members, even if it will adversely affect your own business. Fiduciary responsibility includes quite a few areas, and as you perform your duties, you need to keep these in mind. You have to find and understand any potential conflicts of interest between the parties and the vendors that are performing operations on your fund. It's your responsibility to eliminate members who exert a negative influence on the fund itself. There are many times where a very large member providing substantial premium to the overall group is actually contributing an inordinate amount of losses, and oftentimes it feels like the best thing to do is to keep that premium in the group when in fact the best thing may be to expel that member or force them into complying with safety resolutions and return to work programs, etc. So you have to eliminate the members who exert a negative influence. You also have to make sure you oversee the investments and distributions. Distributions are the return of surplus, the underwriting profit investment income that inures over time, and that's your responsibility as well. Incredibly important to have audited financials and actuarial reports every year. That's your independent view into what was going on. That didn't happen in New York. There weren't independent audits and independent actuarial reports being provided. Above all, you need to make sure the fund is financially solvent and in compliance with the state Self-insurance is actually a privilege. It is not a right. It is a privilege, and the privilege is granted by the state of domicile. But to gain that privilege, you must follow all the rules and regulations of that state. And failure to do that can put your self-insured group in harm's way. The bylaws of a self-insured group lay out a blueprint for the operations and for the decision-making of the trustees. It discusses how and when meetings are held, membership eligibility, the voting rules of the members, the details on all the banking facilities, et cetera, and stuff like that. Issues and voting responsibilities are part of the fiduciary responsibilities. Vendor contracts and management are discussed. Claim settlement offers, you're going to be weighing in on the value of cases and how to resolve them. Regulatory compliance is very, very important and has to be maintained. You're responsible for authorizing the surplus distributions, the return of dividends back to the members. You determine which excess carrier to employ. Rate levels, after rate studies are done by your actuaries. And then the loss provisions that are established for the financial statements are also determined by the trustees in terms of what level of risk to absorb. As I said before, self-insured groups are similar to insurance companies in that they must conduct and provide all the services that an insurance company provides to its members. They do this primarily by employing vendors that perform certain functions for them. Some of the relationships that you'll have and you'll be responsible for maintaining and managing is that you'll have an association sponsor, which may or may not include a royalty payment. You're going to have plan administrators. This is the executive responsible for the day-to-day operations of the self-insured group. And again, that can be a direct hire, somebody that's employed by the self-insured group directly, or you can hire that person as an independent contractor. There's a third-party administrator that does claims administration and potentially the loss control as well. You'll have an excess insurer or carrier. These folks provide the catastrophic protection so that one large loss, a shock loss, won't put you out of business or create a situation where an assessment is required. There's other business services that are provided, again, mostly by vendors. There's accounting work that has to be done, actuarial work that needs to be done. You need an actuarial projection of losses year to year. You also may want an actuary to do rate studies for you so that you're charging adequate premium up front. You'll have an investment advisor because you're collecting premium. Not all that premium will be paid for losses in the day that it comes in. That money will be invested in financial instruments regulated by the state again, and they're usually very conservative, but that allows you to earn investment income on the funds withheld until time that they're needed for making claim payments. So that investment income becomes an important source of additional revenue for the self-insured group. A lot of the self-insured groups require some sort of a bond or an effective way of establishing a security deposit with the state regulator as a hedge against a self-insured group failure. And then typically the self-insured group would want its vendors to have liability insurance of some kind in case they do something wrong, but also the trustees will want to have some protection in the event that they're second-guessed somewhere down the road and there's insurance protection for something that didn't pan out correctly. And then there's obviously the sales and marketing function that have to be addressed. And again, these are the responsibilities of the trustees and the administrator to determine the best course to distribute the products that you and services that the SIG wants to take out to the membership or potential membership. The association sponsor is often required by state rules for a homogeneous group. The association sponsor is actually the organization that promotes and starts the self-insured group. Typically, these can be an industry, trade, or professional organization. And in some cases, especially in the heterogeneous world, fund may have several association sponsors. So it's possible that that association wants to provide workers' compensation out to its association membership through a self-insured group program. The plan administrator, again, is hired by the Board of Trustees. That can be a direct employee, or that can be a hired employee, a vendor. And there's several strong professional administrators across the country. The plan administrator is responsible for carrying out the policies and procedures established by the board. They provide consultation to the trustees. They're the ones that run the day-to-day interface between you and your vendors, you and the underwriting staff, you and the claims administration, and they're the ones that really are responsible for the day-to-day underwriting, claims, loss control. They're, in a sense, they're the chief executive or the chief operating officer of the self-insured group. They manage the day-to-day operations. The third-party administrator, also known as the TPA, also known as the claims administrator, they conduct the claims function on behalf of the self-insured group. They contact the injured workers. They determine whether a claim is compensable or not. They make payments timely. They bring on the appropriate medical resources, and they work to settle cases. And they oftentimes work really, really, really hand-in-hand with loss control. And in most cases, the third-party administrators are also providing loss control services. Now, many of the homogenous groups have found it strategically important to bring loss control services on and have their own staff administer the special programs, special loss control and safety elements of their own program because they're so intense. Excess insurance, again, it provides financial protection for the self-insured fund. The types of carriers you can purchase from, many states have requirements that the carrier has to be at least rated A- by AM Best and have certain surplus requirements, have to be of a certain size. Excess workers' compensation is one of those lines of business that's very difficult to underwrite. There are very few carriers who provide the coverage, and having a good relationship with your insurance carrier is one of the most important things that the trustees should push for within their group. The carrier should be financially strong. Again, the tail on workers' compensation, the payment tail is over 50 years. There's been a lot of self-insured groups who've purchased coverage from carriers who've subsequently gone out of business, and it's very difficult to get dollars timely, reimbursed timely from the estates or from guarantee funds should they apply in certain situations. Typically, the self-insured excess work comp policies, they're reimbursement policies. That means the self-insured group will pay first, and then the excess insurer will reimburse that self-insured group client for that amount above the deductible or the self-insured retention. The excess insurer is the only vendor employed by the trustees that shares in the risk of the self-insured group. Because of that, several of the excess insurers have started to provide a suite of services to the self-insured group to help improve performance, both on individual claims and in the overall management of the program. Care should be taken by the trustees to understand all of the services provided by the competing carriers in the marketplace. This is where carriers differentiate. Because of the long-tail nature of the excess workers' compensation, making sure you retain your records for extensive periods of time is critical. It's known to be a really, really long line, and record keeping is important to make sure that collections are timely. The types of business services, again, that have to be provided, these are normally provided in any insurance company. Again, these are normally outsourced here. You won't have your own finance department or accounting department or actuarial department. but you need to go outside and buy those services to support the operations of the self-insured group. So you'll have accounting services, which are financial audits, tax services, annual report preparation, that kind of thing. You'll also have actuarial services that you'll need to employ. Those review losses and reserves. They advise on reserve adequacy, determine levels of funding required for solvency. They're also in tune with the state regulations on the funding requirements, so they're going to be advising you whether or not your funding is in line with state regulations or not. And then they assist in determining the rate appropriateness. Again, what you don't want to happen is find out that your premium you charged was too light, that you didn't charge enough to cover the losses, and now you have to go back and assess members for the additional premium because you were short up front. In addition, you'll have your investment advisors. These can be the trust departments of banks or independents. There's a variety of folks that provide these services. Again, the state regulators will determine the riskiness of the investments a self-insured group can invest in. Typically, you're talking bonds. Only a small percentage of dollars can actually be in equities, but the investment advisor helps match up the liabilities, the future payment stream on claims with your investment portfolio to help maximize the investment returns. And they'll manage and protect the assets. Again, the idea is to not invest in risky assets. You don't want to lose any money. And then maintain the portfolio in accordance with the regulations. The bonding that's required covers the individual members, the policyholders, and it protects against fraudulent acts by individuals. And again, the bonding is typically required by the states. Business services continued includes the executive professional liability. Typically, you're going to want to have director and officers coverage. In fact, trustees oftentimes won't want to come onto a board like this unless there is directors and officers coverage. It's written for the trustees. It's designed if there was a management error, an omission, something happens that was unthought of. This defends against claims of adverse financial consequence as a result of a managerial decision made in good faith. There's also errors and omissions coverage. This coverage is written for professional advice and service individuals or companies, and it protects against claims of negligence or inadequate work. E&O coverage, again, covers your vendors. You're going to want to make sure that they have that coverage that is in your favor in the event that something they do doesn't work. And you're going to want it on your administrator. Sales and marketing. The Board of Trustees determine the strategy that they're going to use to attract new members and retain the current members. Their options include direct marketing, where you push information out to all the member prospects, again, in a homogeneous self-insured group sponsored by an association in the same industry. Chances are you already have intimate knowledge of all the members in the marketplace that you're going to want to try to attract. So you can do direct marketing out to those folks, and you can attempt to write coverage. The benefit of doing that is you won't have to pay a brokerage commission or an agent commission, so your acquisition costs will be cheaper. The other way you could do it is go through an exclusive agency agreement or open it up to several agents. The benefit of that is that employers are already, for the most part, dealing with their insurance agents to purchase and place coverage and work comp in the other lines. So they may be more comfortable in buying their coverage through an agent. The downside of that is you will have to pay a commission to that agent, so that will take some of your premium. But again, if it's built into the rates, it's a wash at the end of the day. It may actually help you grow and identify more prospects and write more business sooner and more effectively. And again, if you have a single agent or a half a dozen agent specific network, that allows you management and control, and you can manage the operations of the agency to make sure they're out doing the work. Or you can open it up to all agents in the state. You can just be an open market, which means anybody who has one of those members can submit it to you for consideration. Information from the financial statements. Again, the financial statements are really the window into the operations of the self-insured group. Trustees have to be very familiar because the accounting for a self-insured group is going to be different than the accounting you normally see in your own business. Yes, the income statement, there will be income, there will be member distributions or dividends. The big differences in the accounting between a normal business and an insurance company has to do with the reserves, the fact that you don't know your true cost of goods until several years after the fact because claims get reported and paid over time. So that reserve provision is your big unknown, and it's that reserve provision that really differentiates the business of insurance from any other business. So yes, you'll have income, member distributions, potentially. All the operating expenses are listed in the financial statements. You have an income statement. You also have a balance sheet, so your assets and your liabilities, and all of those will be displayed in similar fashion. Fund reserves, again, are the reserves outstanding to pay all future claims resulting from the premiums that were written in that 1 year, or in the case of a fund that's been in business for multiple years, that reserve provision covers all future loss payments. And then the amount of the difference between assets and liabilities is the equity. And again, underwriting profit and investment income belongs to the membership, and it is returned and paid over time based on the regulations of the state. Self-insured group differences, again, on the financials. You cannot close a fiscal year until all claims are closed, so it's not unusual for a fund year to be open for a decade and longer. Again, the loss reserves are estimates. Great care has to be given to make sure those estimates are credible and that they fall within a range of reasonableness. Self-insured groups that fail get this wrong all the time. And then, again, the thing to remember is workers' compensation is a long tail line. While you typically can know about the claims that have happened in a short period of time, it's really very difficult to determine on the serious complex cases how long they're going to be open and what the ultimate dollar will be. So typical balance sheet, you're going to have your assets, cash, reinsurance, recoverable, premiums, receivable. And the liabilities are loss and loss adjustment expenses and accrued expenses and other payables. And then the surplus, member equity, policy, dividends payable, or if that number's negative, that's the amount required to bring the association back into compliance with the state. In that case, an assessment might be required. The income statement, pretty straightforward again. It's revenues and expenses. You have excess revenues or excess expenses, and then if there is a profit, you have potential income tax provision. If you have a loss, you have potential federal tax credit. So frequently asked questions, what happens if revenues exceed operating expenses? If revenues exceed operating expenses, members can receive dividends. Again, operating revenues include premiums paid in plus any investment income. What happens if expenses exceed the revenues? Well, then members face an assessment to bring the fund back to solvency. Again, that's determined by the state. Are group self-insured funds considered taxable? And that answer can vary depending on how the group is structured and operates along with the state regulatory requirements. How long can workers' compensation claims take to pay out? The types of cases that we see in workers' compensation can extend beyond 50 years. All right, the last section is fund management strategies, long-term stability versus short-term gain. When a trustee is making decisions, there's always going to be weighing those two things, long-term stability versus short-term gain. In virtually every decision they make, those considerations are going to be front and center in the trustee's mind. Unlike most businesses where you understand your cost of goods sold, you add your profit load to the cost of goods sold, and everything is fairly short tail, you can pretty much determine whether you're going to be in a profit or loss position at the end of that year based on how you performed. In insurance, that's not true, and it leads to hard and soft market cycles. Again, revenue for a self-insured group is premium plus any investment income. Typically, when investment income is higher, insurance companies are willing to discount premiums to bring those dollars in and invest them, and the investment income will then offset any additional loss that they derive as a result of cutting the price. Unfortunately, for self-insured groups, they don't invest as aggressively as an insurance company can, and so they're unable to compete on price to the same degree as an insurer does at different parts in the cycle. So when insurance companies are aggressively writing workers' compensation, it is dangerous for a self-insured group to assume that because they do it, we should do that too. We don't want to lose members to another insurance company. We'll want to keep that premium in. Unfortunately, those unfavorable acquiring decisions that a fund makes at that point in time can ultimately put their association at risk. In soft markets, for a self-insured group, your margins get squeezed. Your underwriting profit becomes next to nothing. Your rates are artificially low, and you know it. You're living on the edge. You face intense price competition from primary companies. And if your member doesn't realize that you're bringing something more valuable to them, if they don't have any loyalty to the self-insured program, they're susceptible to go for the cheaper price from a primary insurance company. All in all, it's harder for a self-insured group to survive and prosper in that climate. In a hard market, and again, a hard market is defined by how the insurance companies are operating with respect to your marketplace. So in a hard market, the primary insurance companies are raising prices dramatically. This allows the self-insured group to also raise its prices, but not as much as the primary. So now you have a competitive advantage to write additional business at an appropriate price. As long as you're underwriting selectively, you can bring in members who fit a risk tolerance and a risk profile. So you're getting more rate, you're able to compete on price, you're operating in a way that is beneficial to the groups. And again, in hard markets, typically self-insured groups begin to prosper again, and they find it easier to be successful in writing new business. The responsibility of the trustee is to understand the inflection points of the market dynamic, the hard market, soft market cycle. Because it's a dynamic marketplace with ups and downs, underwriting becomes really, really important. It's even more important in a soft market than it is in a hard market. Relaxing your underwriting standards in a soft market is a recipe for disaster. Loss prevention is one of the critical ways you can drive membership loyalty. Again, you're operating in a dynamic cycle, but loss prevention is not impacted by the soft and hard markets. I would tell you that in the primary insurance company world, when the market is hard and they are raising rates and raising prices, they're doing that because their operations are struggling and they have to raise premiums to get back to solvency or get back to profitability. They've already potentially laid off their loss control staff. They've already started to cut back on the expense side of the house as a way to try to get profitability back. And they're doing that without regard of the member need or their policyholder need. Your policyholders in a hard market or a soft market, your loss prevention program is one of your differentiation strategies. It's a way for you as an organization to build member loyalty by bringing special programs out, by being visible, by helping that member manage their enterprise so they have fewer losses and fewer risks. This is an area where trustees can have tremendous impact in setting the direction for the group. And the other area, again, is claims administration. There's a variety of vendors involved in the claim administration practice. You have your TPA, and that TPA is also involved with preferred provider organizations and pharmacy benefit managers. As a trustee, you need to be establishing goals and setting direction and having routine communication with those folks so that you understand the savings that are being generated, the types of claims that are being seen, what areas are they coming from, what can we do to feed back into loss control so that we can eliminate some of the opportunities for these claims in the future. Underwriting strategy, two extremes are inclusive, where you bring every risk in, you bring in all comers, regardless of loss ratio. You make the assumption that you can do better than the primary market and that you're going to take that premium in and be able to do something with it. Exclusive, you focus only on the best of class. You'll eliminate a lot of the potential participants who aren't as strong internally in terms of safety and loss control. Every member has a commitment to driving losses lower under that scenario. In these cases, if you've been very selective in who you write, chances are those members are going to remain very, very loyal to you throughout the cycle. They're going to have lower losses, so even as the primary markets reduce their premiums, you're going to be in a position to compete on the premium side. And again, with loyal members, you won't really have to compete as much as you would as if you were a generalist where you didn't do that. The inclusive strategy, it allows you to grow rapidly in a hard market. If you exercise discipline as the market softens, you're going to lose premium quite fast in a soft market. Your choices in the loss prevention area, again, is it proactive or are you being reactive? Proactive, it usually costs a little bit more on the front end. The successful SIGs have a tendency to pay more, to invest more in loss control, to be more proactive. And they develop services specific to the industry, whether it's logging or transportation or healthcare. They've invested and know exactly what needs to be done to eliminate the hazards that cause the risk, and they invest in those programs, both employee training, and they push out to the members, and they try to hit all the members. Reactive assumes that employers that had a bad experience this year are likely to be the bad actor next year. So it's not unusual to see a self-insured group rank the loss ratios of each member, take the top one-third, the highest loss ratio, and go visit them in the next year, trying to get that employer to address the reasons why those losses occurred and do something with those. Again, it's directed at the high loss ratio members, and unfortunately, losses in many cases are random, and they can be random across your entire membership. And if you focus on the top third and you don't do anything on the bottom two-thirds next year, some of those guys are going to be on the top of the list, and they didn't have to be if you'd have been out there. Claims administration strategy, an aggressive approach to take and a passive approach to take. These are the two extremes. A lot of programs are going to fall somewhere in between. But you need to teach members on the aggressive side, early detection, identify the loss as quickly as possible. All kinds of studies focus on the fact that early identification of a loss is critical to contain cost. The accident investigations have to be strong and complete. Strong medical case management. Again, there's a variety of vendor partners out there that can help direct and manage the care. Most aggressive programs have transitional return to work programs already defined. The association pushes those programs out to its membership and tries to get them all to adopt and make that part of that employer's own program. Dispute resolutions and prompt settlements, Those things are all hallmarks of an aggressive claim strategy designed to minimize the overall loss. Passive, it's not a desired state. The members kind of report claims willy-nilly. There's no real effort on the part of the self-insured group to educate its members that claims need to be reported timely and effectively. They're hallmarked by lack of direction on the medical providers as well. There are doctors out there who will treat injured workers, but really without understanding the work comp system, they don't communicate effectively with the claims administration, and so a lot of leakage occurs. A lot of additional costs get incurred as a result of that. And in fact, the late reports come in, and what happens is the TPA is handcuffed because they don't know the claims occurred. The injured worker's already secured medical treatment. It hasn't gone through a PPO network. It hasn't gone through the pharmacy benefit manager. The TPA hasn't been able to control any of the costs. And again, leakage occurs and costs increase. And then sometimes the self-insured group thinks investment income is more important than a prompt claim resolution. And if you start having that conflict of do I want to maximize my investment income or do I want to contain my costs on the claim side, the answer should always be contain the cost on the claim side. The bottom line, successful groups are those that thrive in both hard and soft markets because they have loyal members. Self-insured groups are by far effective in bringing workers' compensation coverages to the members that they support. The fact that the underwriting profit and investment income is returned to the members incentivize that member to work with the fund administrator to do what they can to minimize loss. That's good for the employee. That's good for the employer. It's good for the self-insured trust. And it's also good for the trustees. To summarize, a self-insured group allows like-minded businesses to pool their premiums. They have a fiduciary responsibility, the trustees do, to make decisions based on the interest of the group. The business functions and administrative functions of the group are under the direction of the trustees. Those relationships have to be managed by the trustees. They should have an interest in who is selected and why they were selected. Trustees must familiarize themselves with the financials of their own programs, and it's a good practice also to take a look at some of the financials of other groups in your jurisdiction to see if yours match up to theirs. Groups should be managed to provide long-term stability for the members rather than the short-term gain.